Hi, hello, welcome to CAD NEST YouTube channel. This is Deepika from CAD NEST. So we have already seen many concepts and conventions of accounting. So here we have matching concept. So what is this matching concept? Matching concept states that the revenue and expenses incurred to earn revenues must belong to the same accounting period. So once the revenue is realized, the next step is to allocate it to the relevant accounting period. So whenever we do expenses, that you including that expenses, we earn a revenue. So that revenue and that expenses to be reflected in the same accounting period, it says. So in simple manner, if the revenue is more than the expenses, it is called as profit. If the expenses are more than revenues, it is called as loss. So this is what exactly has been done by applying the matching concept. So this is what the matching concept says in accounting. So what about next concept is we have few examples over here. Therefore, the matching concept implies that the revenue earned during an accounting year, whether received or not received during that year, and all the cost, whether paid or not paid during the year, should be taken into account while ascertaining the profit or loss for the year. So if it is earned or not, if it is paid or not, but it should be reflected in the same accounting year, it says. So what are the importance of this matching concept? Why we need this matching concept? Because it guides how the expenses should be matched with revenue for determining exact profit or loss for an accounting period, so it guides you how it should be matched with the revenue and how it should be exactly shown in profit and loss account for the period. It will guide you. So this matching concepts help us to guide how to allocate expenses or revenues. And then second one, it is very helpful for the investors or shareholders to know the exact amount of profit or loss of the business. So to know the exact amount of profit or loss, so we need matching concept as well. So what next concept is like realization concept. What is this realization concept? So this concept states that revenue from any business transaction should be included in the accounting records only when it is realized. So the revenue from any business transaction of the accounting year, it is realized. So that is what it says. The term realization means creation of legal right to receive money. Selling goods is realization, receiving order is not. In other words, it can be said that revenue is said to have been realized when cash has been received, or right to receive cash on sale of goods or services, or both has been created. So this is overall concept of realization. The concept of realization states that revenue is realized at the time when goods or services are actually delivered. So when it is delivered, that time, the realization period is called as the realization concept. Then we have few examples here. So if we go through the examples, you'll get to know what is the actual concept of realization now. So a jewelry received an order to supply gold ornament worth rupees 5 lakh. Okay, they supplied ornament worth rupees 2 lakh up to the year ending 31st December 2005, and rest of the ornaments were supplied in the year in January 2006. So in 31st December 2005, we have already supplied 2 lakh. Now the rest will be supplied in January 2006. Okay, the revenue for the year 2005 for a jewelry is 2 lakh. Mary, getting an order is not considered as revenue until the goods has been delivered. So when we get an order, that is not like we have received the entire amount. So when we get an order, when we deliver that, then we receive the amount. That time, that amount is the should be reflected in as the revenue in the books of accounts. That is what it says. Okay, so this is how one example. And what is this next concept is accrual concept. What is this accrual concept? It says a meaning of accrual is something that become due, especially an amount of money that is yet to be paid or received at the end of the accounting period. It means that revenues are recognized when they become receivable, though cash is received or not received, and the expenses are recognized when they become payable through though cash is paid or not paid. Both transactions will be recorded in the accounting period to which they relate. So this is what last year profit will be taken as opening profit for this year, right? So this is how the accrual concept goes on going. So at the end of the year, whatever remains will be realized for the next year as the opening balances. So that is what this accrual concept says. Based on this concept only, we have all the it is the base concept for all the accounting concepts. Okay. So therefore the accrual concepts make a distinction between accrual receipts of cash and the right to receive cash as regards revenue and actual payment of cash, and obligation to pay cash as regards as expenses. So the accrual concept under accounting assumes that revenue is realized at the time of sale of goods or service, irrespective of the fact when cash is received. So when it is received or not received, it goes on going for the next accounting period. So these are few accounting concepts. So we have accounting conventions coming up for the next part video. For more videos, do subscribe our CAD NEST YouTube channel and press bell icon for notification. Thank you.